What's going on, everybody, and welcome to a new video. Today we're going to be looking at arithmetic versus logarithmic charts. Now, put it very simply, arithmetic charts show the absolute dollar value of the change in price. It's essentially the stock price movement as you see it. It's what actually really happens. The logarithmic chart does not change anything in terms of the actual price. It only changes the distance between each price interval. The difference is purely visual, that's what I'm trying to say. So I'll give you an example of a logarithmic chart. For instance, if a price goes from 2 to 4, that's a double up, right? And then from that point on, let's say the price goes from 4 to 6. Well, 4 to 6, that's not a double up, that's a 50% increase. And so the logarithmic chart is going to show that the difference between the 4 to 6 is going to be half of the distance between the 2 to 4. Now, what's the purpose of this? It shows you what your actual gain would be if you were to buy at a certain price. It's based off of the lowest price of the chart, essentially. And logarithmic charts are best used for long-term horizons. It gives you a good idea of what the actual percentage increase is, not the absolute value increase. And it's usually best used for 20% increases in security values. Now let's take a look at Tesla stock. As you can see now that the chart is on the arithmetic scale, you can see that each distance between each interval is equal, and that actually shows exactly what the stock did. However, if we move to a logarithmic scale, you'll see that these dramatically change. The lower you go, the higher the distance it is because, as I mentioned previously, a distance of 100 is bigger from 100 to 200, but a distance of 100 is less big from 700 to 800. And so it's just a different way of quantifying and looking at charts. That pretty much shows another video. It's a very short one. I hope you enjoyed. Thank you so much for watching. I will see you in the next one. Peace.